Hi everybody, and welcome back to our second video in chapter 2. And when we left off, we were looking at posting journal entries to the general ledger. And here is a nice graphic depiction of that general ledger. Here we have our dates. Normally we would have an explanation here. Notice this PR, that stands for posting reference, and that comes from the general journal page number. So we can go find these journal entries if they are pulled for audit or we need to research them for some other reason. Again, we have our running balance down here that reflects the balance in this cash account. Cash is account number 101. So this is very nice from helping you understand what that general ledger looks like. So then we post these journal entries to the general ledger from the general journal, and here it is. We've recorded this $30,000 that we received in cash, and that owner received some stock. And you can see that the two accounts that are affected in the general ledger are shown here, and very nice as far as the next steps in the process. Then we are going to do the following steps in the first portions of creating our financial statements. So we've identified the transactions and source documents. We've analyzed the transaction using the accounting description. We record the journal entry, and then we post it into the general ledger account. And so here is our first one. We've received this $30,000 in cash. You'll remember that from the first video that we did, where we were looking to see what went up and what went down as far as the effect on the accounting equation. And here we received some cash. Cash went up. We generated some common stock. That stock went up. So the two accounts that are affected shown here, and then we record that with our posting reference, which in this case is the general ledger account numbers, and then it goes into our general ledger. Here's our second transaction. We purchased some supplies here for cash. So cash went down, I'm sorry. We credited cash, and we debited supplies, the asset on the balance sheet. And then we show that here in the general journal. Then we are going to purchase some equipment for cash. Cash again goes down, equipment goes up. So equipment's an asset. We're going to debit that in account 167. We're going to credit cash to pay for it in account 101. And as you can see, we have posted that from our general journal here to our general ledger accounts. We do the same thing here for purchasing supplies on credit. Supplies have gone up, accounts payable has gone up, so we debit supplies and we credit accounts payable, right-hand side account. We credit that to make that get bigger. We debit supplies as an asset to make it get bigger. We provided some services for cash. And here we've hit our first income statement account, consulting revenue. This revenue is going up, and we're receiving some cash for our services. So we debit cash and we credit account 403, consulting revenue on the income statement, and as shown, it posts to the general ledger. In transaction 6, we have paid an expense in cash. So in this case, rent expense, we've debited the expense to increase it on the left-hand side. We've credited cash to reduce it on the left-hand side. So then we post it again to the general ledger. In transaction 7, we have paid an expense in cash. So in this case, salaries expense. Salaries expense, we debit to increase it, and we credit cash to reduce it. So again, it posts to the general ledger. Here we've done some consulting and rental services on credit. So we combined these two in this journal entry. So we are expecting to receive this. We have not yet been paid in cash, so we debit accounts receivable and increase it, therefore, to $1,900, and credit consulting revenue and rental revenue for $1,600 and $300 respectively, and then post that to the general ledger. Just to reiterate, you'll notice that in this case we had more than one credit and just one debit, but in total, whenever we do a journal entry, the debits must equal the credits, always. All right, and now our customer is going to pay us the money they owe us from their accounts receivable. So in this case, our cash is going to go up, and our accounts receivable is going to go down, because we're removing that account receivable because our customer has honored its commitment to pay us. So we'll debit cash to increase it. We'll credit accounts receivable, another left-hand side account, asset, and it will reduce it by $1,900. And as you see from this general ledger account, we originally debited accounts receivable. Now we're crediting accounts receivable, and the balance in that accounts receivable 106 account is now 0. And then in transaction 10, we have a partial payment. This time we're paying. So we're going to reduce our accounts payable here with a debit and credit cash to pay that accounts payable. And so that reflects in the cash account and the accounts payable account. Here we pay a cash dividend. Cash dividend is not an expense, as some students can always seem to confuse. It looks just like an expense, though. We're going to debit dividends just as if it was a dividends expense and credit cash to pay it. But it's not an expense. It does not go through the income statement. It stays in the statement of retained earnings as a reduction of retained earnings. And then we're going to receive some cash for future services. Here we're getting paid in advance. So we have not yet earned this revenue. We have a liability to perform these services in the future. So what we do is we collect the cash, so we debit cash, but we credit an unearned consulting revenue account. This is not on the income statement. This is a liability on the balance sheet. Unearned consulting revenue here. And then we're going to pay some cash for future insurance coverage. This is we're prepaying this insurance. So prepaid insurance is an asset, normally a current asset, and we're going to debit prepaid insurance and credit cash to pay for it. Notice nothing here has hit the income statement yet. We haven't used up, or any of this insurance is not yet expired. Now, we purchased some supplies for cash. This is an easy one. Supplies as an asset, cash as an asset. Supplies were increasing, cash were decreasing with a credit. Here, we're paying an expense in cash. So we're going to debit utilities expense. Expense is a left-hand side account. We debit to increase it. Cash is also a left-hand side account. We credit it to reduce it, to pay for these utilities. Again, we post them to the general ledger, and we have a running balance in each of these accounts as a result. Now we're going to pay another expense in cash, this time salaries expense. This is pretty normal that we would pay salaries in cash. Normally we would have an outside payroll service that wants all that money up front in cash. So we rarely have a payable for salaries. So in this case, we're going to debit salaries expense, a left-hand side account. We debit it to increase it. And we're going to credit cash, a left-hand side account. We credit it to reduce it. All right, so we put all these transactions and summarize them in our general ledger. And here's all our general ledger balances. Notice we have an ending balance in all cases here. These ending balances are what we're going to use. Ending balances is what we're going to use for our trial balance. And that's what we're going to do next. Here, we're going to prepare these financial statements from this trial balance. So let's look at that. We list each account and its amount from the ledger in the trial balance. That should say the ending amount here. And we compute the total debits and credits and the total of the credit balances, and we look at that trial balance to ensure that the debit balances equal the total credit balances. And here we did just that. Here's our trial balance, and we have all these ending balances for all our accounts, and as shown, the debits equal the credits. Okay, and if the books are in balance, then this is going to happen. So sometimes, if we're not using a sophisticated mechanical system, which will not let you post anything that does not balance, sometimes if we have a manual system, we can have some inaccuracies. So we can go search for those errors. We'll verify that they correctly add. We're going to take a look to make sure that we've entered that all the accounts have been entered from the ledger. We're going to see if the debit balances are mistakenly placed, or any debit or credit accounts are mistakenly placed on the trial balance. We can recompute each account balance in the ledger. We can verify that each journal entry is posted correctly. And lastly, maybe even verify that the original journal entry has equal debits and credits. Okay, once we've got a good trial balance, then we're going to look at our balance sheet. That's a point in time. And our ending balance sheet is a point in time. The statement of cash flows, the statement of retained earnings, and the income statement are all a period of time. So, I think that's good enough for that. And here are income statements. That's going to report revenues less expenses incurred by a business over a period of time. We're eventually going to zero out that income statement and roll those balances into retained earnings and start that income statement over for the next period. And when we do that,